Hello everyone, this is Professor Kent. Today I am going to talk about serial bonds. As some of you guys requested me to do a video on serial bond. Before we talk about the serial bond, what I wanted to do is before we do the entries for the serial bond, we want to know the definition behind the serial bond. So in this case, bond issue that matures in installments. So any bond that matures in installments are called a serial bond. Bond that matures in installments are called a serial bond, or a note, installment note. Serial bonds are frequently used by who uses these type of bonds is used by schools, municipalities, and provincial and federal government. This is an example that I found, and we're going to go through this example by doing all the transactions for this type of bonds. In this case, a corporation issued a 4-year, 1 million serial bond on January 1st, year one. So what we did is we issued a serial bond on January 1st. That is year one, and it is a 1 million bond that we 1 million serial bond that we issued. Going further, and they're saying they're paying 5% stated interest rate. In this case, stated interest rate is same as a coupon rate. So the coupon rate is 5%. The requirement of the bond is that this interest that we are calculating has to be paid at the end of the period. So year one will be due on December 31st, year two will be due on December 31st, year two, and so on. So if it's a 1 million bond, and then we're going to make an installment, there is 4 years. So the life of the bond is 4 years. So in this case, we're going to make a 250,000 payment. We're also going to make an interest payment at the end of the year. So then they think Smith and the investor negotiate for some time and finally agree to 6% effective rate. So in this case, a marker rate is 6%. So the coupon rate is 5% and the marker rate is 6%. Now anytime we issue any type of bond, what we needed to do is first we had to calculate the issuance. We normally do a transaction at the time you issue the bond. We need to calculate the payment schedule, and we have to journalize each year. So when you do a serial bond, in this case, when you're doing it, the way to calculate the present value of your bond. So first we needed to calculate the present value of your bond at the time you issue the bond. We know the marker rate is 6% and the coupon rate is 5%. If it's a serial bond, I'm going to show you how to calculate the present value of the bond. It's a little bit different from the normal bonds that we calculate. So in year one, we're going to make a payments of 250,000. So what we're going to do is we're going to make 4 payments of 250,000. So year 2, year 3, we're going to make another 250,000. Year 4, we're going to make another payments of 250,000. The question is saying is when you have in the question we are making 250,000. Plus we need to make an interest payment for each year. So in this case, what is your interest payment is going to be for the end of the year. So in this case, our face value of our bond was 1 million, and then what we're doing is we're making a 5% interest. So in this case, our 50,000 was my interest payment. So altogether we made a payment of 300,000 in year one. So when you do it year two, we're making a principal payments of 250,000 each year. So what we have to do is we have to calculate the interest. The interest will be the face value of the bond was 201 million. We already made a payment at the end of the year, 250,000. So we're left with 750,000. Multiply by the 5%, and that will be your interest. So in this case, 37,500 will be my interest. Altogether, I made a payment of 250,000 plus the interest. Altogether, we made a payment of 287,500. Then you go to your year 3. So my principal that we need to pay is 750,000 minus the minus the 250,000. The face value of our serial bond is 500,000, and you calculate the interest on that. In this case, it is 25,000. The payment I am going to make at the end of the year is 250,000 is my principal, 25,000 is my interest, so I'm going to make a payment of 275,000. Then we go to our last year. Our face value for our serial bond is 500,000. We're making the last payment, which is going to be 250,000. So then we have to calculate the interest of the 5%. In this case, the interest will be 12,500. And then the payment we're going to make at the end of the year is 262,500. So now these are my payments. That's going to be in year one. We're going to make a payment of 300,000. Year two, we're making a payment of 287. Year three, year 275,000, and year four, we're making a payment of 262,500. Then now can we calculate the present value of our payments? Yes, we could do it. So in this case, I'm going to do it at the side. And then how you're going to calculate the present value? In this case, that becomes your future value. Your future value becomes 300,000. Your N is 1. Your IY is your marker rate. In this case, marker rate is 6%. We're not making any coupon payments during the year. We're making it at the end. So that's, in this case, payment is 0, and you're going to compute your present value. When you compute your present value will be 283019. You're going to do the same thing for the next one. Your future value becomes your 287,500. Your N is 2. Your IY is equal to 6%. Your payment is equal to 0. You don't need to do a payment, and you're going to compute your present value, and that will come up with 255,874. You go to your year 3, so your future value becomes your 275,000. Your N is going to be 3. Your IY is equal to 6, and then you're going to compute your present value. That will give me 230,895, and year 4, your future value becomes 262,500. Your N is 4. Your IY is 6, and your payment is equal to 0. You're going to compute your present value. That came out to be 207,924. So now we calculated the present value of your each installment plus your interest, and once you calculate it, you're going to add all the present values that you calculated, and that's the amount you're going to record at the time you're issuing the bond. So that comes out, the present value of all your future payments are 77,712. So the first entry we are asked to do is calculate the present value of the bond. Did we calculate the present value of the bond? Yes, we calculated it. Now we could do the entry. So our first entry will be at the time you issue a bond, and in this case you're issuing a serial bond, and the entry will be debit the cash and credit will be your bond payable. So the entry debits, and the account does not change. However, how you calculate the amount changes. So in this case, 977,712, 977,712. So that's our first entry. Now when we are doing the second entry, we are going to do, they're saying, the question was saying is that the bond contract specifies that 250,000 of the face value is also paid annually at the same time as the interest. So if you issue the issuance of the bond was on January 1st, now 1 year is gone by. Now we have to make our first installment, and we also have to make a first payment. In order to do that, in order to do your December December 31st, year one entry, what we needed to do is we needed to do an amortization table. This amortization table might be a little bit different, but I'm going to show you an easy way to do this. I'm just going to put it in here, this side. So in this case, we're going to do an amortization table. It's a little bit same than, little bit similar to the one we did when we do a straight line or effective method. In this case, we have a year one, we have year two, year three, and year four. And first one is we are going to make a cash payment. In this case, this is what we normally do. And then we have interest expense. So we know the cash is always using the coupon rate. In this case, coupon rate is 5%. Interest expense is calculated. They're saying the effective, in this case, it will be 6%. And we are going to have another column here. That's the principal payment. In this case, we are making a 4 payments of 250,000. So this is an extra column that I brought it in here to show you how we're going to calculate the interest expense and how we're going to calculate our carrying value of our amount. So now any bond, since this is a discounted bond, why we say it's a discounted bond, because the present value of our bond is 977,712 and the face value of our bond is 1 million. So this is a in this case, the bond is a discounted bond. So let's do next column is your amortization of your bond. So we're going to do bond amortization, and then we're going to calculate the carrying value of your bond. Sometimes if you visualize it, then you could see it. If you were to, when you're doing the coupon, when you're doing the cash payment, it is on the carrying value of the bond. I'm just going to put it underneath it to show you how we're going to do the cash payment. In this case, it's 1 million times the 5%. In this case, it is 50,000. So in this, when you have it is a 50,000. So this is how we calculate the first payment. So now when you're calculating the carrying value of the bond, we started off with the 97712, and when you're calculating your interest expense is calculated using the carrying value of the bond times the 6%. In this case, I'm going to use another ink to show you this. It should be 58663. So now when you're amortizing the bond, in this case, if you were to amortize it, now what you could do is there's two way of calculating it. I'm just going to do it in this case. If we have a cash payment and we have an interest, difference between those two is my bond amortized. We amortized, but we made a payment of 250,000. In that payment, we had a discount that we amortize. So in this case, if what you're going to do is you're going to take the principal minus, in that principal, what we have is the minus the amortization, and that I came up with a number of 241,337. So in this case, that will be a minus. So that's how much the bond when we are calculating the carrying value of the bond, that came up to be 736,375. And then when you're going to do your next interest expense, it will be using 736,375 multiply by the 6%. It will give you 44,183. And now this is used carrying the face value of the bond. In this case, the face value, we started off with 1 million. We already made a first payment, which is 250,000. So the face value of the bond becomes 750,000 multiplied by the 5%. You have a cash payment of 37,500. And then what I'm going to do is take a minus between those two. I think I have an extra 0. So what I'm going to do is I'm going to take a minus from each other. So that will give me 66883. So I'm just rounding it to that. So what I'm going to do is, so this is, I'm going to take it here. So then what you're going to do is minus it from that. So what you're going to do is you will have a the carrying value will be minus 2317. So we have it that 24373. So then when we do that, once we minus that, we find out the carrying value of our bond. In this case, carrying value of the bond is 493058. And then we are going to go ahead and then we are going to calculate our next interest payment, 58 times the 6%, and that will give me 29,584. And then in this case, our face value become, from this point, when from year 2 to year 3, minus the 250,000 and multiply by the 5%. In this case, we made a payment, our cash interest expenses 25,000, and then I will take difference between those two. That's the discount that we amortize. In this case is 4584. So in other words, when you're looking at it, what you're going to do is you minus it from each other to see how much of the carrying amortization we amortize. So in this case it is 245,446, and then that gives me the carrying value of the bond. In this case, it'll be 247,642. That's the carrying value of your bond. So then when I'm calculating my last year, what you're gonna do is, in other words, you can should come up with end up with a 0. So let's see if we end up with a 0. So multiply by the 6%. In this case, we have 25,000. That's what the payment. That's the principal. That's the last payment we have, times the 5%. In this case, 12,500. And then when we calculate your using the effective rate, your interest expense is 14,858. I take the difference between those two to see how much bond we are amortizing. In this case, the discount we're amortizing 2358, and I will have it to minus it. In this case, it will come up with a 247,642, and that is 0. So now once we calculated the table, what you could do is you could do the entries very quickly. I already showed you the first entry. I'm just going to do it in here again. Debit the cash and credit your bond payable. I just when I discounted bond,